We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
A widely watched aspect of the yield curve has been in headlines recently, and I want to help you better understand what everyone is talking about and how it impacts your investments. In this episode, I'm going to explain in plain English what the yield curve is and what it means when the yield curve inverts, the relationship between yield curve inversions and recessions, and how to think about your portfolio given the current environment. Let's dive in and start by defining the yield curve. The yield curve is a line that plots interest rates for bonds with different maturity dates. You can plot the yield curve of corporate bonds, global bonds, municipal bonds, and so on, but the most common yield curve discussed among financial professionals is the U.S. Treasury yield curve, and that will be the focal point for our discussion in this episode. You've probably heard financial professionals and the media alike talking about interest rates rising or falling as if all bond yields are rising and falling in perfect tandem. But in reality, the yields for various bonds behave differently depending on their maturity and credit quality. This means that when interest rates fluctuate, the shape of the yield curve changes too, which is simply a reflection of different maturities experiencing different interest rate changes. The yield curve's shape is often used as an indicator of how bond investors feel about the direction of the economy. Now, if I were sitting across the table from you right now, I'd be breaking out a pen and paper to draw some sample curves, but since you're listening to me, I'm going to rely on your left hand to help me explain. Start by straightening your left hand as if you're about to do a karate chop, with the palm facing down and parallel to the floor. Now, point your fingers up and to the right while keeping your wrist in the starting position. This is what a normal yield curve looks like. Yield curves normally slope upward because investors naturally demand a higher return for tying up their principal for longer periods. Longer-term bonds carry a greater risk of exposure to inflation, and a steepening curve signals expectations for a healthy economy, whereas a flattening curve, and beyond that an inversion, reveals some concerns. So imagine your left wrist represents the yields on the shortest bonds, like 1-month treasury bills. The joint at the very base of your thumb is the 2-year treasury yield. The 2 thumb knuckles are the 5-year and the 7-year yields, and the tip of your thumb is the 10-year treasury yield. Then we can say your fingers represent bonds with maturities beyond 10 years, with the longest fingertip representing the yield on a 30-year treasury bond. If you tilt your hand so that your fingers are pointing more towards the sky, you have a visual representation of a steep yield curve. A steep yield curve signals that bond investors expect heightened economic growth and inflation. Now, I'm not entirely sure who the arbiter of what qualifies as steep would be, but I generally see people say it's when yields on 30-year treasuries are 2.3 percentage points higher than 3-month treasuries. This type of steepness is something that typically happens at the onset of an economic expansion. A flat yield curve often signals economic transition. You can make your hand flatten so that it's parallel with the ground. As you can see now, yields on long-term rates are the same as yields on short-term rates. Now, if you tilt your fingers on your left hand towards the ground such that your wrist is higher in the air than your fingertips, what you see in your hand now is a visualization of the dreaded inverted yield curve. An inverted yield curve occurs when short-term bonds yield more than long-term bonds, which is visually represented by a yield curve that slopes down and to the right. This yield curve shape is a sign that bond investors expect an economic slowdown, if not an outright recession. In this situation, bond investors expect rates to be lower in the future. Now, one final thing to keep in mind with yield curve shapes is that different parts of the curve can steepen, flatten, or invert, just like you can bend or flex your fingers of your left hand to change its shape and steepen, flatten, or invert in different places. So now that you have a good visual for the yield curve, what are the potential concerns among bond investors when short-term rates approach or overtake long-term rates? Generally, there are two main concerns. The first, the Federal Reserve could quickly raise rates to combat inflation and in doing so, cause a recession. The second, investors could be willing to accept lower relative interest rates to hold longer-term government debt, believing that long-term prospects for the economy are currently poor. So naturally, the recent flattening of the U.S. yield curve may have you wondering whether a recession is on the horizon and whether you should make a change to your portfolio in response. Let's start with that first question. Is a recession on the horizon? Today, 2-year yields are higher than 10-year yields, which is the type of inversion that has occurred before 7 of the past 8 recessions without a false signal. But the gap between the 3-month and 10-year yields has a slightly better record as a recession prognosticator, calling all 8 recessions without a false signal. And that spread remains positive and fairly steep today. In fact, this 3-month, 10-year spread has actually widened in recent weeks, meaning the yield curve has steepened at the shortest end of the curve. A second important consideration when talking about yield curve inversions is that yield curve inversions do not cause recessions. I think people tend to get caught up in the fact that when yields on longer-term Treasury bonds are lower than short-term Treasury bonds, a recession has typically followed in the next year or two. But the inversion isn't the cause of the recession. The yield curve is not a crystal ball. It's simply an aggregation of global investors' expectations for the economy. And I believe the curve today suggests that the bond market expects the Fed to raise rates quickly in an attempt to fight off inflation and in the process, dampen economic growth. So instead of thinking about the yield curve inversions as a recession precursor, perhaps it's better to think of it as a sign of economic fragility. In this specific instance, if inflation doesn't moderate, the Fed could have to tighten more, which could tip the economy into recession. A third important consideration is how to appropriately compare the current yield curve to historical data. Interpreting any one signal is challenging, but I think that's particularly true today when there's so much uncertainty about inflation, Federal Reserve policy, the labor market, and now the war in Ukraine. Against this unusual backdrop, we need to be careful in drawing parallels to history. For example, consider that real yields haven't inverted yet. Real yields are the nominal bond yields minus inflation. In the prior 3 yield curve inversions, which were all followed by recessions, the real yield curve was fully inverted in 2019 and 2006 and almost perfectly flat in 2000. Today, the yield curve is very steep when using real yields. Now, that doesn't necessarily undermine the signal bond markets are sending today, but I think it's an interesting point to share in the context of using one set of data to conclude that a recession is imminent. With the Federal Reserve signaling its intent to aggressively raise rates, expecting weaker economic growth makes sense, but only within the context of everything else that's going on. Now, there are lots of professionals that theoretically have plenty of information and context about what's going on. In fact, Bloomberg tracks the median probability estimate from 80 economists that the U.S. will enter a recession in the next 12 months. The latest survey showed that economists think the risk of recession is higher. The median estimate had been 10%, and now it's 25%. But the long-term average for this number is about 19%, meaning that about a fifth of the economists always think a recession is coming in the next 12 months. Now, the few times that the median economist estimate spiked, recessions didn't emerge. And there's one exception, and that's just prior to COVID, but I'm going to take that number with a grain of salt, since I don't want to assume economists somehow knew there'd be some novel virus that would go on to start the first pandemic in over 100 years. So why do I even bring up the median economist estimate? It doesn't seem to be a reliable indicator. But I think the narrative of increasing recession predictions aligns with the yield curve flattening and in some instances inverting, as well as the stock market sell-off. People are worried that the Fed's going to choke off economic growth as they try to slow down inflation. Even though I'm repeating myself, I'll say it again. The yield curve, as well as a variety of other economic indicators, are pointing to an economic slowdown. Whether or not that slowdown turns into a recession is really anyone's guess. As I frequently say, predicting recessions or market downturns is not how you achieve financial success. Instead, the key is to plan on recessions and market downturns occurring in advance. If you plan for these things to happen in advance, then you can set up a plan and a portfolio that allows you to save, spend, and invest with confidence. We never know when or why the next market downturn will occur, but we know that recessions and market downturns will continue to happen with a similar frequency as they have in the past. With that in mind, let's touch on that second question that's been coming up these days. Should you make a change to your portfolio in response to the yield curve inversion? For stocks, Avantis recently published a study of the spread between 10-year and 1-year Treasury yields versus U.S. stock market returns over the next 6 months, which showed that there was no strong relationship between the two. And I'll be sure to share that image in the show notes on the longterminvestor.com. Avantis also plotted the yield curve spread over time against subsequent 3-year U.S. stock market returns. And again, they found that there wasn't a very strong relationship over the sample period going back to 1973. As is always the case with stocks, you're being paid to accept uncertainty and periods of heightened volatility. Without these characteristics of stock investing, there would be no reason to expect higher returns than what you earn on bonds or cash. So as long as you've invested in a portfolio that is born from a financial plan that takes regular downturns and recessions into consideration, then you shouldn't need to make any adjustments to your stock portfolio. As for bonds, the same holds true, but I think it's almost more difficult to stomach that advice because bond returns have been negative at the time when stock prices are declining. But even though bonds have experienced losses recently, they have still provided diversification benefits since the magnitude of losses is often significantly less than that of stocks. Short duration bonds in particular have done relatively well in a diversified portfolio today because they're less sensitive to rising interest rates. I personally find fixed income to be the most interesting area of the investment world these days because starting yields are historically low, which means that expected returns are so low that mistakes are arguably more costly than ever. The thing is, the mistakes people make with bonds are the same as the mistakes they make with stocks. People tend to chase performance. They want to invest in what's doing best or what they think will do best. People also feel the temptation to time the market. After all, interest rates have been rising on the long end of the yield curve, and the Fed is telegraphing their intention to increase short-term rates. That makes it tempting to want to sell bonds to avoid losses and get back in when rates stop rising. But how do you know that rates are done rising? Just like market timing with stocks, you have to get the call right twice. Once on when to get out and once on when to get in. But I'd strongly encourage you to take the easier route of staying the course. After all, higher rates are a good thing for investors if their time horizon is greater than the duration of their portfolio. It's really just simple math. Rising rates can be good for bond investors and savers as current and future income benefits from being reinvested at higher rates. So again, if your time horizon is longer than the duration of your fixed income holdings, then higher rates will actually improve your overall returns. This is a really important concept to understand. In summary, yield curve inversions signal an economic slowdown. And even though they historically have been followed by a recession in the following 12 to 24 months, the 3-month 10-year yield spread still hasn't inverted. Plus, recessions are a normal part of investing, so you should plan on them. Planning on periods of lower returns and temporary losses is far better than trying to predict when and why they'll occur. Finally, if you have a solid financial plan in place, then you shouldn't need to make changes to your portfolio in response to the latest market developments. And if you don't have a solid financial plan in place, then maybe this is the time to do so. I'll be sure to link to a free ebook in the show notes called The 8 Essential Elements to Comprehensive Financial Planning. And whether you have an advisor or not, I think you'll probably find it valuable. Again, that's on the longterminvestor.com. And while you're on the show notes page, please subscribe to my email or shoot me a question. I try to respond to every email I receive. As always, thanks for listening, and until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.